So, they made a big point about something that's really obvious, saying that the U.S. economy is not a closed system. It's open to, international trade, and they even had questions about it. So I don't feel like that's typical of a CPA question you would get. We know that we can transact with other countries, and we know reasons for international activity. Those things are obvious, right? New markets to sell in, commodities to obtain at lower costs, whatnot. So absolute advantage and comparative advantage. Pretty interesting. So reading it, it doesn't make sense, really, to me anyway. But when they gave that example, I'm like, that makes perfect sense. Because the way they explained it, I'm like, I don't know what the heck that means at all. But then when I saw them explain it using U.S. and China and the televisions and the financial services, that made sense. So I added that to the notes because I would not want to lose that. So with their little example, the point they're making is with the same input. That's important. You got an input, this or that with it. The U.S. company with that input can make 20 televisions or 60 financial services, whatever that is. The Chinese company with the same input can do 100 televisions or 80 financial services. So China has an absolute advantage with either product, right? They can produce either of those more efficiently than the U.S. company. That's the definition of absolute advantage. They can produce a good more efficiently than the other entity. They can do that better than U.S. They can do that better than U.S. Absolute advantage with either. That made sense reading. The comparative advantage thing, the way they explained it, did not. But the example made it come to life. So it said, if the U.S. company produces televisions, there's an opportunity cost. We know by now what opportunity cost is. It's the cost of the next best thing, or what we're giving up, rather, on the next best alternative. So if they produce televisions, they are giving up 3 financial services, right? Every time they produce one of these. So the opportunity cost is 3 financial services for them to do televisions. If they produce financial services, the opportunity cost is 1/3 of a television. Chinese company, if they produce televisions, it's going to cost them 0.8 financial services. If they produce financial services, it's going to cost them 1.25 televisions. So, given all of that craziness, the U.S. company should do the financial services, right? The Chinese company should do the televisions. So the Chinese company has a comparative advantage over the U.S. entity regarding televisions. They can produce it at a lower opportunity cost than the opportunity cost of the good to the other entity. That wording, I didn't know what the heck they meant. But then I see the example, I'm like, I got it. It makes sense now. And then regarding the financial services, the U.S. company has a comparative advantage over the Chinese entity. So there you go. And Porter's 4 factors, quick and easy concept that does show up in each of the 3, Klein, Becker, and everything. About the same coverage, just like, oh yeah, here's this, but they do all mention it. So they talk about these factors that lead to a national competitive advantage. So there are factor conditions, the extent to which a country has a relative advantage in factors of production. There are demand conditions. It's the nature of the domestic demand for the product. Strong domestic demand enables them to devote more attention to it. Related and supporting industries, so the extent to which supplier industries are good, the better we are, because we can use those. And then firm strategy, structure, and rivalry. So well-developed strategies different organizational structures and intense rivalries lead to higher competitive advantage. They're operating at a higher level. So, read it. Nothing to really, I don't think, memorize, but all of the different test prep softwares do mention those 4 factors. So I guess it's important. But the questions here, these took a little while. Number 1, which of the following situations would it be advantageous for a country to export a manufactured product? So when you're looking at international activity, comparative advantage is key, right? We kind of saw that example. So that makes C the answer. And these others are kind of out there. I think you're probably between B and C regardless, right? So absolute advantage, we just saw in that example, isn't the key. Comparative advantage is. 2, I worked it all out and was feeling good and missed it. Because did y'all do the same thing? Because this is in units of cost instead of units produced. So I got it backwards, and I was so mad because I was like, I get this. I'm working it out. I'm fine with it. Looked at it and I missed it. I'm like, you got to be kidding me. And then I saw. So the lesson there is read carefully. So this is units of labor. This is cost, not units produced. And then when they put this one on us, then we've got units of output. So you got to be real careful with both of these. So this is units of cost. Cost is bad, so we want to be lower on the cost thing, right? So says, yeah, these are hard because it's like, which way, what's going on? Okay, Australia, good A, good B. These take a little while. Which country has an absolute advantage in the production of A? Which country has an absolute advantage in the production of B? All right, so be careful because this is cost rather than units produced. So Brazil has the absolute advantage for B because that is a lower cost. Australia has an absolute advantage for A because that is a lower cost. Only costs them 4, it costs Brazil 8. They have an absolute advantage. Okay, anyway, so the answer is B. Which I guess is that. All right, so this one, comparative advantage. So this one is units of output. So more is better. I'm going to be honest with y'all. If I'm studying for the BEC section of the CPA exam, I'm probably going to look at this and say, nope, because it takes a lot of energy to figure these out. And I'll probably roll the dice on it and say, I hope I don't get one of these. That's just what I would do. What do y'all think about that?
Okay.
That's what I would do.
I mean, now we actually pay attention to units of output, units of labor, or some form of it. And then once you do that,
Yeah,
it's logical.
it is, but it isn't. Because, so, unless I made this harder than I should. So, with this. Australia. It is. Yep. Opportunity cost of producing A. what does A cost in terms of B? 2 A's cost 4 B's, right? So right? So you take the number of B divided by the number of A's. Kind of like if you were figuring out how much units cost, you take dollars divided by the units. Here, the cost is units of B, so you're taking units of B divided by what you produce, right? Opportunity cost of producing B is 4 B's cost 2 A's, so 2 divided by 4 equals 0.5 A's. So that's what's going on with Australia. Brazil. Opportunity cost of producing A is 1A costs 8 B's, right? 8 B's for 1A. Opportunity cost of B is 1B costs 8 A's. So unless I'm taking the long way on this, that's pretty much what you have to do, right? So Australia is going to produce A because they have a comparative advantage in producing A over Brazil. Australia has to give up 2 B's to make an A. Brazil has to give up 8 B's to make an A. That's what you're comparing to, comparative advantage. So they have an advantage over them. Brazil is going to do this because it costs them 0.125 A's, whereas it costs Australia 0.5 A's.
It sounds weird, but I feel like I can just eyeball them.
Yeah.
If you can, I'm impressed. I can't, but maybe, yeah. I mean, yeah. Did you? If you can eyeball it, that's awesome. If y'all can eyeball it, I can't, but if y'all can, that's great. You know, if I saw that on the test, I'd be like, well, I'm not going to kill 10 minutes reasoning through this. I'd just answer something. But that's me. Choose your strengths. That is not my strength, that thing. It would take me a long time to reason through all this. I even have it written down here, and I'm sitting there trying to think about it as I'm writing it, and I'm like still having to think it through. It eventually comes to me, but that's it with it right in front of me. So I guess what I'm saying is I'm slow on those. It takes me a while. So if a country can produce 10 automobiles or 4 tractors using the same input, what is the opportunity cost of 1 tractor? So a tractor is going to cost how many automobiles, right? So the cost is automobiles. So we're going to say 10 automobiles divided by 4 tractors. And it's going to be 2.5. That I can handle. That's only 1. The others are like 4, and then you got to start comparing them, and it just takes a while. It's doable. It just takes a while. From an international perspective, the U.S. economy is, and then you get that after all those others. Number 6. Which of the following typically is not a reason for economic activity by a U.S. entity? This is kind of simple too. Yes, you want to diversify. Yes, you can obtain resources cheaper overseas sometimes. Yes, you can reduce production costs. I'm going to protect your capabilities. 7 is kind of basic but important. the concept of comparative advantage in international business activity is based on which of the following differences in relative opportunity costs. And we've obviously seen that working through all those that we've worked through, right? Okay. So this section, issues at the national level, you know, they kind of give us a little introduction into all this exchange rate stuff. And that stuff gives you a headache trying to reason through it and think about, you know, if it's strengthening this, if it's weakening. I mean, it's not intuitive immediately. Anyway, you really have to kind of think it through. But then you kind of get the hang of it the more you practice them. Take good notes. Take notes of your thought processes as you're working through a problem. And, it starts to get easier and easier. So this section doesn't have a lot of real big content in it. They talk about exchange rates, and they do mention that the lower the cost. So, you know, a foreign currency is a commodity like anything else. You can buy it, you can sell it. Kind of hard to wrap your mind around sometimes, but the lower the cost of a foreign currency, the cheaper those foreign goods are to us. You know, our dollar will buy more foreign currencies, and then with those foreign currencies, we can buy more foreign goods with it, right? That makes sense once you think it through. They talk about the balance of trade, which is just the difference between imports and exports. Pretty easy to remember that. Then they give us dumping. I don't know how important that term is. They gave us a problem on it, so I went back and added to my notes after that. I didn't initially take that note. Did you? Okay. See, it's been so long since I've taken these types of classes that I can't remember what's covered in those and what is not.
I feel like dumping is a huge part of that. Like, because it's basically getting rid of products that we don't want on people that don't need them.
Yeah, you know, it's, I don't know, but yeah, I figure at most knowing the definition will get you by, and you probably wouldn't show up anyway. Balance of payments is pretty intuitive as well. It's a summary of our transactions with other nations for a period. You know, our accounting minds can easily process what that is, right? And then the accounts they use are a current account, a capital account, and a financial account. I figure that's sufficient to know. So yeah, this isn't too bad. And our problems weren't too bad either. Which of these is engaging in this dumping thing that we were talking about? So, you know, as you look at that, all of these are charging more to the foreign customers than to the domestic customers. But the only one that by definition is engaging in dumping is this one right here. Because, you know, regardless of the fact that, you know, the domestic price is lower than the cost, and the foreign price is lower than the cost. So by definition, the fact that the cost is 60 and they're charging foreign customers 59, that by definition is dumping, even though they're also charging less than cost domestically. So I guess if anything, that might throw you a bit for a loop, because, you know, you read the definition and it's like you get the idea that dumping is selling these all foreign for a much less number and kind of bumping it up domestically. But in this case, it was kind of the opposite. But yeah, this by definition is dumping. I don't know how important that is. But number 2, which of the following items represents a reduction in the balance of payment account for the United States? So balance of payment. That's that summary of all the transactions with other nations for a period of a year. When our earnings, when our inflows is more than our spending, there's a surplus. Obviously, when the opposite is true, there is a deficit. So that's all it is, our transactions with other countries. So which of the following represents a reduction in that balance of payment accounts? So A, we've got exports of services. So exports, we're selling, money coming in, that's increasing. We've got loans to domestic entities by foreign banks. So that's loans to us. So that's money coming in. C, we've got the foreign countries are purchasing assets in the U.S., so they're spending here, so that increases. Here's where we're buying from them. We're spending over there, so that's money going out. That's pretty easy, right? Number 3, which of the following is the most likely result of imposing tariffs to increase domestic employment? So a tariff is essentially a tax on imported goods, makes importing more expensive. So what is the result, the likely result? A is the answer here. And I guess this is more process of elimination maybe than anything, but the book described what's going on here is that they think that exports will likely be, wait a minute, nothing. Yeah, they think foreign countries would retaliate and exports would decline too. So our export people are going to be kind of shifted over to our domestic industries. Yeah, I don't know how you study for a question like this. You just kind of reason through it and eliminate the ones that are obviously wrong, right? Number 4, in the long run, the imposition of an import quota on a commodity is likely to provide the greatest direct benefit to, so if you're restricting imports, obviously people making stuff here are going to benefit, right? So you're restricting what you can buy from other countries. That means the domestic suppliers are going to be the ones who are benefiting from that. Pretty obvious. Yeah. Yeah, it does. It said the greatest direct. Yeah, and this is probably a little more vague than a CPA question would be, but I guess the whole idea of the greatest benefit would be to the suppliers, and then yeah, a little vague. You're right.
The only other thing I would consider with that is we get a lot of goods from China that are cheaper than here, so they're more expensive to us here.
Well, that's true. That could be. Yeah.
And that's
There's some what ifs there,
Yeah.
but the fact that you even notice that means you know what you're doing. So yeah, you're good. Yeah, the fact that you can reason through stuff like that, you're definitely on the right track with it. Number 5, simple little, which of these is not one of the accounts in that balance of payment, think of it. So that one's kind of quick and easy. And which of the following would not be an argument made by U.S. unions in favor of trade protectionism? We wouldn't want to increase imports. We're trying to limit imports. So pretty easy, more somewhat of an introductory type little section really before we get into this one that just makes your head spin.
I feel like it's like politics.
Yeah.
Like that first one, like, okay, so this is on the politic game. They're probably talking about politic game. So we're gonna enact these different policies.
Yeah, you're right. You're exactly right. All right, if any section consistently gave people trouble, it was this one. And it cracks me up as I read the comments. It's like, this one was horrible, this one drove me crazy, number whatever was weird, and then you see one like, easy, no problem. And that's usually somebody who didn't even bother with it. And yeah, so kind of cracked me up.
I remember, I think I put on this one, number 4 was hard. Not specifically.
Number 4, I don't remember off the top of my head, but we'll definitely look at it. All right, well, I took a lot of notes here, probably more than I really needed to. But stuff, so exchange rates, you definitely need to know your way around those. So you got different ways to state it. There's a direct exchange rate or an indirect. So that's pretty basic stuff that you need to be familiar with. Forward, all that kind of, I think, consistently gave people a little bit of a headache. So, again, trading in money, foreign currency, it's like any other commodity, just goes up and down in value. So you got a spot rate. That's what you can go and trade for here and now, run down to the bank and do it, right? A forward rate would be what you would kind of agree to now for a trade that'll take place maybe, later on, in a month or so, or I don't know. So that's the forward rate. So you would agree on it now for that to happen later. So a discount or premium would come into play depending on really what people think is going to happen between now and when this trade, exchange is going to take place. So if the forward rate is greater than what you could do now, obviously that means that the market thinks the value of, if we are the dollar, the value of the dollar is going to go down and that foreign currency is going to go up. That foreign currency will sell at a premium, a forward premium. Future price of the foreign currency is greater than the current price. So what you're agreeing to now would take that into account. Opposite for a discount. So that's the difference. I don't think calculating it here will be necessary a whole lot. I don't think that would, I think that's too deep. But I stuck it there anyway. But I think that's too much, in my opinion. So, and there's a problem or two that makes us deal with some of this, and we'll get to that in a second. But then it seems like most of your questions probably come from this content right here. What causes demand for a country's currency to go up or down? So the important thing, this is definitely important. Demand for the country with the higher interest rate would be greater. That's a bit counterintuitive to me. But once you think about the reason, then it does make sense. So if the interest rate is higher in one country relative to another, foreign capital will flow into the higher interest rate country because they can earn more money there. So demand for the country with the higher interest rate would be greater. Their foreign currencies flowing in, they're purchasing our dollars or wherever, and demand goes up. Makes sense, right? So that's very important. Definitely understand and be ready to deal with that. Inflation, that tends to show up too. Currency that retains its purchasing power tends to increase in value. So lower inflation is better. Definitely tuck that away. This other stuff, a little less important. Public debt level, the current account balance. Those don't tend to show up in problems as much as interest rate and inflation does. So you can kind of narrow it down to those two, in my opinion. And you could probably reason through the others, right? Country with a whole bunch of debt. I don't know. That's a little much. I don't think you'd have to have that in your arsenal on test day. I really don't. So I think with those two, you'd be fine. Supply, that kind of touches on things we've already talked about, the monetary policies and things, but it's mentioned again here. What could our Fed do to manage supply, which would in turn manage exchange rates? So we can buy dollars. Less supply in the market, so that would increase the value of the dollar. Or it could increase the interest rate, which goes back to this. So there you go. And then effective exchange rates, we've already talked about that, right? And this is a little much, I think. But, you know, when we have a stronger currency, it takes less of our currency to buy another currency. And that's pretty intuitive once you kind of think about it, right? Some of these problems, and I love how they'll hit us with number 3. Oh, you go through all that, and then they hit us with, this number 2 with this little calculate a cross rate, which they never even mentioned how to do that, did they? That kind of made me angry. So I had to look that up because I didn't know how to do that. But
Is that festival, like, is that like something that we should actually
I
have?
don't know if I specifically looked at that.
Or like they would at least have to give you like the formula.
I don't remember looking at the other companies to see if they covered that too, but I can. You've got Becker. Yeah, check Becker. We're gonna grab my Gleim book. I need to start bringing that anyway when you look things up like that. Be right back. I don't see anything about it. Seems a little too deep.
They just mentioned like
They mentioned what?
like 2 things about like exchange rates and all.
Really? Gleim mentions quite a bit. They say it's really important to understand all these relationships between the value of the currency and the different factors of trade, like we're definitely going over. And they say specifically when the interest rate goes up, the currency value goes up. They highlight that. And then they mention inflation next. So that's definitely important, but I don't think this crazy thing for number 2 is worth our time. It's easy enough, but I don't think we need to crowd our brains with that. That's what I think. You like it?
Yes.
Well, you can crowd your brain with it.
Oh, no, I mean, I like not.
Oh, you like not?
I'm sorry.
I thought you were like, I like it. I love this stuff. So I'm going to learn it no matter what you say. Then you'll get on the test day and you'll get one of those and be like, ha ha. Told them.
Email you and I would say, I'm not. I'm gonna do exactly what I said. Take two off the bat.
Yeah. Do I? The right answer is 1.39. Yep. That is the right answer. We'll highlight that in green. So yeah, I mean, all you do is take 1 over 1.48 divided by 1 over 2.06.
How I thought it is like X
Yeah. Yeah. It's easy enough to kind of reason your way through it. So I wouldn't worry about it though. Number one is pretty obvious actually. So U.S. travelers to Europe usually exchange dollars for euros, assuming that euro supply is static. How does this affect demand? Well, they're demanding more of it, so it increases demand. It would increase the price. It's pretty obvious, right? But then better questions. So number 3 says, a rise in the value of domestic currency could be moderated by a central bank, so they're going to affect the supply, by a central bank decision to do what? So our currency is going up. How could they decrease, how could they decrease the demand? So which of these would work? Well, we know D wouldn't work, right? We've said increasing interest rates would make our boost demand, right? Currency flow, foreign currency would flow in, and they'd want to buy more and more of our dollars to do more and more trading. So we can rule that one out. Buying domestic currency, that's obviously going to be an increase in demand. This selling foreign currency in the foreign exchange has nothing to do with our domestic currency, so that's not going to affect anything. So it's going to have to be this, right? Selling domestic currency in the foreign exchange market, which is another way of saying buying foreign currency. Right? So I don't know. That was a little silly of a question. But 4, which of the following changes would create pressure for the Japanese yen to appreciate relative to the US dollar? So I guess we are Japan here, if we're framing our minds right. So we are looking at the yen going up relative to the dollar. Which of these would cause that to happen? So A says an increase in inflation in Japan. So inflation up, less purchasing power, that's going to decrease the value of the yen, right? So that's not going to work. B says a change in U.S. taste in favor of Japanese goods. Obviously, there's your answer, right? I guess it's always good to read all the questions or answers real quick to see if there's an obvious one that jumps out at you before you take the time to reason through the others. But that's it, right? Increase in U.S. interest rates. U.S. interest rates go up, more yen flowing to the U.S. Demand for U.S. dollar goes up, yen goes down, right? So no, and then blah. So yeah, these are easy. That one is easy. Number 5 is real obvious too. Generally, exchange rates are determined by supply and demand in the market. That's a stupid question. 6 is a tough one though. Really tough actually. So it says, assuming that the real rate of interest is the same in both countries. If country A has a higher nominal interest rate than country B, then the currency of country A will likely be selling at a discount or premium, forward discount, forward premium, or rule out C and D. So this requires you to know a lot of things, right? You need to know what real interest is. You need to know what the nominal interest is. And then you have to kind of do it once you already know what those are. This takes a lot. So real interest rate is an interest rate that's been adjusted to remove the effect of inflation. Nominal interest rate is the rate before considering inflation, right? So it kind of helps to draw this out, otherwise you'll get it backwards. So country A, country B. Nominal inflation real. So here's what I did. They said the real rate of interest is the same in both countries, so I just made up a number, 1 and 1. Could have used any number, I guess, but 1's nice and easy. So the rate of interest after it's been adjusted to remove inflation effects is the same for each country, right? Since country A has a higher nominal interest rate than B, so I just said, all right, well, 5% for A, which is higher than 4% for B. I'm just making up numbers, right? So if that's the case, then the inflation rate for country A is 4%. Inflation for country B is 3%. So all of that, and this is just my way of doing it, but I needed to draw that out for me to be able to visually figure out what's going on here. So all that just to say that country A has higher inflation. That's what it all boils down to. If you could have eyeballed that and figured that out without drawing it out, that's good. I had to draw it out to wrap my head around it a little better. So it all comes down to inflation. That's the only difference between the two based on the information they gave. Real interest rates are the same. Otherwise, we could say, hey, higher interest rate creates more demand, but interest rates in real interest rates are the same. So inflation rates are what's different. So A has a higher nominal rate, which means a higher rate of inflation, which means less purchasing power, which means a decrease in the value of company A currency is expected. Because of higher inflation. So we're expecting A's value to be less, then A will be selling at a discount. This is one of the harder problems on here to me. What did y'all think about that one?
That one was never much.
I had to sit there and draw it out before I could wrap my head around it. I couldn't do it any other way. Because I kept thinking, well, higher interest rate would be more demand for it. But then I kind of realized interest rates kind of are the same when it comes down to it, and it's all about inflation. So yeah, that was a tough one.
Not show up for us, you think?
Do what?
You think that'll do it? 5 questions show up for us?
It could. It'd be one of the harder ones, but yeah, it could.
And if you discount the spot, because so you can go ahead and eliminate C and D. So why would you go ahead and eliminate spot?
Yeah, spot is spot. Spot is what it's trading for now. So there's no discount or premium. Discount or premium comes into play when you're thinking, what am I willing to lock myself into now regarding a future exchange? And like make a mess of it. So yeah. Okay, this is a direct rate. You all know that. So 7 is basic. 8. All right. What is the effect when a foreign competitor's currency becomes weaker compared to the US dollar? So US is stronger, foreign is weaker. So A says the foreign company will have an advantage in the US market. And then you're like, that doesn't sound right. But it is. So A is right. So let's think about this. So US dollar is stronger. Foreign currency is weaker. Foreign goods are going to be cheaper. US is going to demand more of those goods. From our point of view, we have a stronger currency. Foreign goods are cheaper, we just said. The US is going to have to compete with that. So they're going to have to maintain those low prices. And honestly, they're going to have trouble competing with that because everything's cheaper over there, right? Because of the exchange rate. So the foreign company is going to have the advantage in the US market because of that. Number 9. What did you say? Oh, I hated this one. This one wore me out. I got it though, but yeah, it kind of wore me out. Yeah, I know. Me too. I was like, okay, who's who here and what is going on?
Would that be a serious question or something that like?
Rambling?
Yeah.
No. The CPA exam questions are way more polished than this, and they're not going to use these cutesy names like this either. It's going to be easier to follow. Yeah. Some random econ professor got cute writing this one, and it made it kind of difficult. That's what happened.
I hate the way the English is written. Like it didn't even use the name of the.
I know. Yeah. The E is there. Yeah, I know. Yeah. Bah. Yeah. This one's kind of a handful, but it all comes down to imports are rising. So that's the important thing here. Imports are rising for E. Imports are declining for W. How will E's currency react to W's currency? So E's importing a lot. W is not importing a lot. So if E's importing a lot, they're going to demand a lot more foreign currency. We're assuming W. I guess they're doing business with W. Otherwise, why are we comparing the two? So I guess we're assuming that if E's imports are rising and we're talking about W, they're buying a lot of stuff from W, right? And then on the other hand, E is not importing a whole bunch of stuff, so they're not buying a bunch of stuff. So increased demand in W by E, yeah, I'm telling you this wears me out, means W's currency is in higher demand and will become stronger. Right? They're doing, all the business is flowing into, which of these again? That's what drives me crazy about this. All the business is flowing into W. So W stronger, E's will go weaker, which may tell us backwards from what I just said. But yeah, this one was,
it just doesn't make sense. With this stuff, you would think the country that's spending more and the country that's spending less and doing, in a recession, the one boom, you would think the one that's doing well, they're constricted, but it doesn't, and that's.
Yeah, and this may be a little too vague of a question, and there may be some, well, what about this and what about this? You know, it's not like this one thing and this one thing only affects things. But the way they're setting this up is evidently E and W do business with each other, and we're just considering that and that alone. But yeah, I'm with you, because as I'm writing notes about this problem, as I'm doing it, first thing I wrote is E's economy is booming, which immediately made me say stronger. Yeah. But
I think it's very important, which is sign of their
They are spending, so their money's flowing.
More than,
The money's flowing to the,
Yeah. So W's getting all the business
even though they're in a.
and all the demand for their current, it all comes down to E demands more of W's currency. And the whole problem is about how do these currencies react to each other? How does the exchange rate change because of this?
It's like the way I saw the question before. It's like that opposite mindset.
Yeah.
Of how I would normally think of it.
Yes, a lot of these are very counterintuitive.
So what ultimately makes it better to be equilibrium when it's going to be the same? Because one's importing and one's not importing as much, so essentially like their inputs should be equal. I don't know if that makes sense.
It does. It does make sense but that's way too much depth for, you're going way beyond what whoever wrote this question is getting at. Yeah. Like I said, this is too cutesy of a little question. And in doing that, they put too much stuff in there that isn't supposed to matter to the problem, but we're reading it and saying, well, that should affect this. Whoever wrote this didn't have that in mind. They should have just said imports are rising here, exports are whatever, and then left it at that.
That does help me the way she said it, that if you're importing, that means you're not exporting. So the person who's importing is actually having the better economy. So like that would make the other question make sense. And this question makes sense.
Yeah. Okay. Yeah, I'm with you. There you go. The fact that y'all can reason through it like this means y'all are going to be fine on these.
Right, so,
Unless you overthink it
I
and
think
run
so.
yourself.
so because E isn't able to make it themselves, they have to import it from W.
So I'm not thinking because they can't. I'm looking at like how the business cycle goes through phases. If you're at the top, you're gonna go down. You're gonna be like doing equilibrium.
Right.
And so if you're at the top, you're gonna go down.
Okay.
All right.
And then if they're in a recession, they have to go up.
Okay.
Eventually. I know this is weird, but I just think of the business cycle.
Yeah.
Okay. I'll work that.
And he likes graphs, so that helps him.
Right. And it does, because it kind of, you have the equilibrium of the two coming together, because they're in a recession. All right, I follow you. See, now that's helpful.
That makes more sense.
And I think
Good.
that this question kind of gets at maybe what you're saying as far as the whole equilibrium thing goes. Yeah. Why not?
Why did you say no?
All right. I think we were good enough on that. Okay. You want to break or do this section and then the break? Let's do it. I like that. There's some skippable questions on this one. Definitely. All right, more on exchange rates, but not a whole lot of content here. Risks when you're dealing with exchange rates. This is more of a FAR topic, both of these, really. On FAR, you'll have to deal with foreign exchange transactions, and there's always a risk of, anytime you have a receivable from in a foreign currency or a payable in a foreign currency, the exchange rate changes in between the time you enter into that and the time you settle it. Could work to your advantage or to your disadvantage. That's
Financial reconciliation.
Mhm.
with 25 companies, and most of them are like public speaking companies.
Yeah.
Oh my goodness, the currency exchange difference on a monthly, there was like 2 million.
of exchange rate gains or losses?
Yes.
Wow. Yeah. So you'll see that in FAR. If you take business combinations, I don't know if he covers that in there. Typically, it's covered in an advanced accounting course, which we call business combinations here. But yeah, that's the whole idea. You know, somebody owes you money from a sale today. They owe you whatever foreign currency, and then in 30 days when they pay it, exchange rates fluctuate, and you'll either come out better or worse. Unless it stays exactly the same, then you come out exactly the same. So that's a risk of doing business with foreign currencies. Translation risk has to do with if you are a big company with a subsidiary in a foreign country, their balance sheet and income statement, everything will be denominated in euros or whatever. When you present your consolidated statements, you have to translate those into dollars. So that just makes your numbers look different, you know. So risk doesn't really affect you unless you actually change it. But yeah, translation risk could occur, and then just the economic risk of it. But not a whole lot of meat to this little chapter. They say one thing you can do to kind of mitigate that risk is to kind of match things up, have equal receivables and equal payables in that currency denomination, and then they'll offset each other. Gain on one, be a loss on the other, and you're fine. It says seek to delay, collect, time yourself like, oh, exchange rate's doing a deal. Let's hold off on collecting that until things are better, or let's hold off on whatever. And then you could always do a hedging thing, which we'll cover later, using forward rates, futures, options, currency swaps, blah, blah, blah. And then they talk a little bit about these hedging type instruments. And these are good definitions to carry around with you, honestly. They show up in different areas of content that we cover in accounting. So forward exchange contract and a foreign currency option kind of accomplish the same thing. The big difference is a forward exchange is an agreement that you're going to do it, and it's going to have to happen. So you're agreeing to buy a foreign currency whenever for whatever, or you're agreeing to sell if you're on the other side of that, whenever for whatever, and you got to do it. An option contract is something you can get that will give you the opportunity to do something, but you don't have to. So, if exchange rates don't force you, you have more opportunity to come out better there. You might have a right to buy a foreign currency for a specific rate, and that may not be something you want to exercise because the rate's better than what that option was. And then you say, nope, not exercising that. I'm going to do what's actually happening in the market here. So that's really the difference. With a forward exchange, you have to do it. With an option, you can if it works to your advantage, or you can throw the option away if you don't want to do it and it doesn't work to your advantage. That's the difference. Now, they give us a bunch of questions, and not all of these are good. Some of them are kind of junk. The first ones are a little better. So number one, U.S.-based company, investing capital in an emerging market operation that has a lower expected return rate compared to the expected return for alternative domestic operation, which of the following statements correctly supports this decision. So we're a U.S. company, we're investing overseas, and we expect a lower return on something compared to if we had just invested in a similar thing here. Why would we do that is the question. So the answer is, if we expect the U.S. dollar to decline in value relative to the foreign location's currency, that would be something we would want to do, right? So you're investing in a foreign country, smaller rate of return, but you're getting all these strong foreign currencies which when you convert it back to dollars, converts to more dollars. Our dollar's weaker. That strong currency that you're earning buys a whole bunch more of those. That gives you an extra boost. That's why you would want to do that. So this is an important question. It's an important concept. That one you need to take with you for sure. And it's pretty intuitive, honestly, once you think about it for a second. Does that make sense? All right. Number 2, what is this? Okay. This is easy enough. I don't know if it's something you would get or not. It seemed like it could be, though. I hate that they use such big numbers like 20 million, but yeah, this is definitely something you would need to know how to do. Company considers investing 20 million in a foreign company. The company suspects that the exchange rate may fluctuate soon. The exchange rate at the time of the investment is 2.57 foreign currencies to a dollar. After the investment, the rate changes from 3.15 to a dollar. What is the change in the value of the company's investment? I feel like this is pretty important. Maybe not necessarily the percent change, but maybe a question might say, what's the new value of the investment or something like that? But maybe percent change. You definitely need to know how to do a percent change, so why not? So you enter into this 20 million, and that converts to 2.57. Always just use FC for whatever the random foreign currency is consistently, even if it's even if they specify pound, euro, peso, yen, rupee, whatever. It's nice to just make it always FC for foreign currency. So that will equal 51,400,000 foreign currencies. So you invested, and that's what you got. You got 51,400,000 of this foreign currency. Exchange rate changes to 3.15 to a dollar. So what dollar could you convert to if you decide to sell off whatever that investment is and bring it back to US dollars? Well, you've got 51,400 foreign currencies, which you can now convert at a rate of 3.15 to a dollar. You now have 16,317,460. You have lost money. So what did you end up doing? You started with 20 million. Ended up with 16,460. And you always divide, percent change, you always divide by your early number, right? The 20 million. So it's an 18.4% decrease. It's all good stuff to know how to do. I don't know that you get a question exactly worded this way, but some component of this could show up somehow. So yeah, this is a pretty important one. Three, I don't feel like.
I struggle with these.
Well, here's the thing.
All these calculations, they didn't make sense.
There's different definitions for short and long, depending on, here we're talking about currency conversion. So a short position is kind of a different thought process than, with some other security. I feel like this is pretty skippable for the energy it takes to run through it. That's what I think. The answer was A, but And we can talk about it, and we can kind of shortcut our way through it a little bit if you want to. Um, you know, when you go short on something other than what we're talking about here, it's usually the idea is you're selling something you have thinking it'll go down in value, and then you'll buy it again at a lower price. But here, it's just dealing with currencies. So, if you're in a long, I really don't think it's worth the energy. Y'all wanted to skip this one? I think so. I think it's too much. I don't think it's worth the trouble. Yeah, no. Skip that one. Number 4, significant decline in the exchange rate of U.S. dollar will have which of the following effects? So, weaker dollar will help. What now? Yes. Yeah. So, yeah, you got to think of it from the other way.
I was
We've been,
thinking of it the way she said.
yeah. So the answer to this one is it will benefit U.S. exporters. Yeah, think of it however you want, but again, weaker dollar. Strong foreign currencies coming in that converts to more U.S. dollars. However you want to think about it, but yeah, it sounds like y'all reasoning your way through it fine. Number 5, here's that call and put option. This one was kind of an interesting one to think through. An American importer expects to pay British supplier 500,000 pounds in 3 months. Which of the following hedges is best for the importer to fix the price in dollars? All right. I am the American importer. I have to pay pounds in the future, so I need to buy pounds. So I don't need to sell pounds. So buying a put option would be buying the ability to sell pounds. So I don't want to do that. And this would also be selling pounds. I don't want to do that. No, sorry. I don't, here I'd be selling somebody the right to buy British pounds. I don't want to do that. I don't want to sell somebody the right to sell British pounds. You just kind of have to put, kind of think about what exactly is going on here. So A is it. I am buying the right to buy pounds at a fixed price. That's what I want to do. So a call option is the right to buy something at a fixed price. That one's kind of fun to think through. The rest of these, not the rest of 6 is skippable. 7. 7's good. Here's the way I do these, just because it's easier for me to think in terms of this. I think in terms of journal entries. It says, assume a U.S. company purchases shares of a French company for 1 million euros on March 1st, when the exchange rate was 1 euro equals $1.10. Available for sale security, hold it for 8 months, sold it for 1.2 million euros when the exchange rate was a euro equals $1.23. Gain or loss, how much? All right. So, and y'all may, this is just the easiest way for me to do it. I just say, okay, because I'm an accounting person. I bought an investment for cash. How much was that? It was 1 million foreign currencies, which translates to $1.10 each. That investment in terms of dollars is 1.1 million. Doing it in journal entries makes me not have to think. All right. Time moves. Exchange rates change. I sell it. I sell it for cash. I sell it for, here we go. So I sell for 1.2 million euros, which I will translate to dollars. New rate is $1.23. So I end up selling it for 1,476,000. Investment goes off the books. Plug the gain or loss. Plug in a credit. Credits are always gains. That's my thought process. Now, I know it would be a lot easier to just say, well, 1,476,000 minus 1,100,000 is obviously a gain, and that's how much it is. But I don't know. That's the way I will navigate through a lot of different problems. It's just throwing journal entries on there and plugging gains or losses. It's easier for me. So that's just what I do. 376 is the gain. Y'all may not like journal entries as much as that. Questions on that? Comments? 8 is very skippable, so we'll skip it. So that gets us into transfer prices. We're going to breeze right through some of this, but let's get through some of this so we can feel better about where we stand. Quick and easy sections here. So international transfer price, same idea as transfer price before, except now it's across international borders. The only new thing that kind of comes up here, which is kind of interesting, is they can manipulate tax rates in countries to their advantage. IRS and OECD limits that to, arm's length, a valid arm's length transaction, but you can still get the lower end of that arm's length requirement to kind of manipulate taxes to your advantage a little bit. But that's really the only new information here. The questions themselves were kind of skippable, except for the ones that dealt with tax rates. Number one, long but easy, I guess. And it takes a minute to think about it, I guess, just to make sure you didn't get backwards on it. And they did make it a little difficult throwing 3 different companies in there, and you're flowing from one to the other and then the other to another. So global is the parent, 2 subs, and this is where it gets difficult. It's like, all right, who does what? So you've got Gerco to Inco, Germany, and I've just now got that. Germany in English. Anyway, so Ger goes to Ing, and then Ing goes to global. What do we want to do as far as transfer prices go? So you want the highest cost in the companies with the highest tax rates. You want lower income in those countries, in other words. So you want, Gerco needs the smallest income, right? Because their tax rate, or between those two there at the beginning, right? Germany to England. Germany's higher tax rate, so we want the smallest income there. So they need to charge a smaller transfer price, right? So they'll make less. So you want to minimize Germany to England. So minimize Germany to England. You want to do that. Minimize Germany to England. Do that. Oops. So we're halfway there. So that rules these out. And then England to global. So global has the higher tax rate, so they need the smallest profits. So they need to charge the heck out of them. So you want to maximize that. So there is your answer. So C is it. Y'all do okay with that one? Takes a little bit of thinking, but right. Skip 2, skip 3, skip 4. They are useless. 5 is another tax one. So such a long question. All right. A multinational company operates a production facility in country A, a distribution outlet in country B. So A sells to B. Tax rates are 40% in A, 50% in B. So B has a higher tax rate. They need less income, right? So A sells to B. B needs to show less income, so we need to charge B more, right? So without having to reread that, is A the answer the way they framed it? Okay, good. Mark down the answer. So those are pretty easy. Y'all have any questions on those? Okay. All right.